Well, we are seeing a bit of a split picture in stocks today with that latest economic data raising questions about the strength of the consumer. Retail sales declined 0.8% last month, much more than economists expected. That data coming on a day where two major economies, the UK and Japan, slipped into a technical recession. To discuss what this means for the path ahead for investors, let's bring in Jeffrey Kleintop. Jeffrey, it's good to talk to you today. You know, how do we look at what's happening globally right now in the context of the economic data that has been relatively strong in the U.S.? Yes, retail sales plunged a little more than expected, but if you look across the board, it feels like there's a bit of a divergence that's happening.
There is. And I think the big story of last year, and one that might reverse this year, is that much of the rest of the world was weaker than the US because of their tie to manufacturing. You see, there was a manufacturing recession last year. We saw it in the Purchasing Managers Index. We saw it in factory output. We saw it in trade. In fact, we even saw it in demand for cardboard boxes, the things that manufactured goods and trade go into. Demand for cardboard boxes fell 10% last year. That's starting to turn around, though. So economies like Japan, Germany, the UK, very manufacturing-centric economies, suffered recessions last year, whereas the US, much more service-oriented. We had Taylor Swift, driving a lot of entertainment and travel spending. The US bucked that trend, but now we're seeing a recovery in demand for cardboard boxes, a recovery in the survey of manufacturers. 2024 could be a year where manufacturing turns back into growth territory. That means some of those economies that were very weak last year, two that you just mentioned that slipped into recession, could turn around and grow, maybe even accelerate their pace of growth this year, even as the U.S. begins to slow down. So that could mean a reversal in some of the sector leadership we've seen over the last year.
Jeffrey, you could argue that underlying the strength, the relative strength in the U.S. economy has been the consumer. How big of a concern is this data set that came through today? Yes, it's just 1 month, but it seems to show there's a bit of a crack that's starting to form.
Possible. I guess I'd also point out that most U.S. consumers are now piling onto their credit cards in order to support that spending. They've eclipsed their income gains, and now they're digging into more and more debt. So that's a concern. It limits the maybe extent of that resilience. And I do worry a little bit about a weakening job market later this year, as we've heard from many business leaders talking about additional headcount reductions. Usually that takes 6 to 9 months to actually flow through. So we could start to see some weakness there, in addition to those service industries that are now slowing down in the U.S. We could see some layoffs there. There are 10 times as many jobs in services as manufacturing in the U.S., so that's where we could see that slowdown. And if people feel their jobs are more at risk, maybe they don't borrow as much to sustain that spending. So I do think there's a bit of a slower momentum there for the consumer in the U.S., though maybe not an outright recession.
Yeah, Jeffrey, turning our attention back to international here. I mean, we started by talking about the data, the data we got through from Japan slipping now into the fourth largest economy because of that contraction we saw in GDP. And yet I can't help but notice that the Nikkei hitting a 34-year high, largely driven by some of these chip-related stocks. I mean, does that speak to just the disconnect that we are starting to see between the macro landscape and then sort of just the enthusiasm in the markets around very specific sectors? Or is this really just Japan specific?
I think with Yeah, sorry, I had a little audio difficulty there. I think some of this is Japan specific, in that Japan's economy is very different than its stock market. Japan's companies tend to manufacture and sell 70–80% of their products outside of Japan. So weakness in Japan isn't necessarily tied directly to weakness in revenues or earnings for Japanese companies. But it's worth noting that I think Japan's economy has shown better signs of growth, or at least its earnings potential here. And some of that may be triggering rate hikes this year by Japan, and that might incentivize more money coming back to Japan, funding more operations as the currency strengthens, interest rates tick up a little bit there, and that could be good news. In fact, Japan's Ministry of Finance has been showing some data money's been coming back to Japan and its stock market this year, in addition to last year. Last year was also a good year for stocks in Japan. So I think Japan is one of those more manufacturing-based economies that could see a stronger 2024.
Jeffrey, you've always got a good pulse on what's happening globally here. As we talk about Japan, I'm also curious to hear what you're seeing in Asia broadly? I mean, we've been talking so much about the sell-off, the big declines we've been seeing out of China. Those investors, some would argue, moving over to a market like Japan as well. I mean, how do we sort of connect these moves as China tries to stem the outflow, and yet we see a huge influx of foreign investments, foreign investors coming into the Japanese market?
Yeah, that's true. I also went to India, well, which has seen a lot of inflows lately, and Indian stocks have done pretty well, and its economy is doing well. So it's interesting. We tend to think of regions as homogenous, but they're not. China is obviously suffering with a lot of domestic concerns tied to the property markets, weighing on its stock market, whereas Japan now seeing a turn in the manufacturing situation. India just picking up business from China as a more friendly destination for manufacturers. So we're definitely seeing a shift in capital flows and growth dynamics within Asia, and that makes Asia still a very attractive investment destination. And people often think of if China's slowing down, that's bad for all of Asia. But what we've seen is evidence that that is not the case, and in fact, there are some real investing bright spots.
Jeffrey Kleintop, Charles Schwab, Chief Global Investment Strategist, joining us there. Apologies for some audio issues, but appreciate your time today.